Yesterday, the U.S. Environmental Protection Agency announced its new rules, its new standards for vehicle emissions. And tucked away in a small part of the report is the impact that those emissions will have on U.S. oil imports. Now, it won't come as a surprise to Canadians that Canada supplies 61% of U.S. crude oil imports. So, what kind of an effect will these new regulations have on the Canadian oil industry? I'm going to talk to Kevin Birn, who is the chief analyst for Canadian oil markets for S&P Global Commodity Insights. Kevin, good to see you as always.
Likewise, good to see you too.
Look, I worked this out, and the numbers go out. It's 20 billion barrels of imports in total that will be avoided thanks to these, according to the EPA's modeling. I worked that out. It's about 1.67 million barrels a day average between now and 2055. That's their period. Is this going to have an effect on Canadian producers or not, do you think?
Well, I guess it's more what we anticipate, versus what you would have anticipated anyways. I think most people think that North American refined product demand was going to decline. Certainly, these policies could put more downward pressure on it. What we see, to your point earlier, the U.S. consumes somewhere between 15 to 16 million barrels per day of crude oil and makes it into refined products, the gasoline, diesel, and whatnot. Canada is the largest source of foreign imports in the United States today. The U.S. imports just over 6 million barrels per day, and Canada makes up about 3.8 of about 6.2. So you're 60% or 61%. So I think certainly your headline is that Canadian imports could be affected. But I think the question is whether this is a net import number they're giving out or a specific import number. What I mean is the U.S. produces a tremendous amount of oil and exports its oil, as does Canada export its oil to the United States. This is the net balance effect. Right now, Canadian exports to the United States go through the Midwest and supply the Midwest and go down into the Gulf Coast. And the U.S. Gulf Coast would be Canada's largest consuming region. And the supply of Canadian crude is such a state through the infrastructure that we have access to. It goes offshore and is exported from the U.S. Gulf Coast presently as well.
One of the questions that you and I have talked about in the past, because you're kind of an expert on the oil sands and heavy crude, is will the decline in oil demand affect the heavy crude, Canada's heavy crude, in the same way that it'll affect light sweet crude, which is what almost all of what the Americans produce? And the reason I ask is because there are 10.5 million barrels a day of heavy crude refining capacity in the world. 5.5 million barrels a day of that capacity is in the US. And it's not, as you have made the point many times in interviews, light and heavy are not easily substitutable. And does that insulate the oil sands exports more than otherwise might be the case?
Well, certainly, yeah. I mean, you and I have talked about this before. The Canadian barrels, both we have light barrels and we have synthetic light barrels, and we have heavy and heavy sour barrels that get exported. The synthetic crude oil mostly is sold into the U.S. Midwest, as is our light oil exports are principally consumed there and in Washington State. The heavier barrels transit down into the Midwest, where it meets those complex heavy refineries that are purpose-built to process heavy crude. And the Gulf Coast also is is probably the world's largest single heavy oil consuming region on the planet. And that consumption or the configuration those refineries have invested in has given them a competitive advantage because it gives them greater flexibility to process more complicated barrels where a lighter facility would not be able to process the full value of a heavy barrel. And so in that sense, there's a symbiotic relationship between the supply of Canadian heavy sour and the consumers in the United States and the refineries that are designed to process it. And in that, to your point, it would provide some of that. I don't want to say shelter. The Canadian producers wouldn't be immune to shifts in global demand, and there's bigger factors in terms of what happens to the overall price. But certainly that relationship we anticipate to continue to be, and those U.S. Gulf Coast refiners, the competitive advantage they have is predicated on access to the supply of heavy sour crude oil from Canada as well.
But it's still the case that even if demand falls, and so assuming that the refineries, the heavy crude refineries in the U.S. still import that amount of Canadian crude, heavy crude, but the prices would fall. So the returns to the producers would fall. And what about the fact that at least two Canadian producers own heavy crude refineries in the U.S.? Suncor and Cenovus both have at least one and maybe more. I just forget the exact number. But how does that all play into it?
Well, there's a few things here. Maybe I'll just back up and make the point. What we saw over the last decade is we saw, the U.S. have undergo the shale gale and the tight oil revolution, and a tremendous amount of supply coming online, but it's all been light. And certainly the U.S. refineries invested in configuring themselves to maximize that, but they didn't descale the heavy complex refineries. That light crude oil went offshore and was exported. And the Canadians continue to increase heavy sour production, even as U.S. grew leaps and bounds in terms of availability of crude. The Canadian crude still found a home, targeting those heavy crude oil refineries that we're seeing reductions in supply from heavy sour providers internationally. And that's what Canada largely did was take market share from contracting Latin American exporters, or push that offshore, because the Canadian crude was landlocked going down into the Gulf Coast region. You're right. The other side of this is, the ability to land equity barrels into your own facilities. So Canadian producers, some of them have refining capacity, like you mentioned, both in Western Canada and some refineries in the United States. That allows them to see the full value chain in terms of taking the value of extraction of a heavy barrel in Canada right through to refined product. And that also provides them shelter and the ability to land that barrel into their own facility should there be disruptions in the availability of demand somewhere else in the market. So that does provide them a greater flexibility and ability to shoulder some of the instability that we've seen historically in the differentials as well.
So Kevin, my take on this is that we know the IEA has been forecasting peak oil demand in 2030. We're seeing more and more policies like this one. The U.S. Inflation Reduction Act also has a lot of stimulus for increased electric vehicle sales. And so I think everybody's expecting it at some point. There is going to be a decline, but the significance of the EPA's number here, this 1.67 million barrels a day on average, is the acceleration of the trend. I mean, we can't forecast what's going to happen in 5 years, 10 years, 50. It's a very disruptive time. It's pretty uncertain, but the trends seem to be accelerating towards electrification and a contraction of global crude oil markets, maybe a little quicker than we had thought. Is that fair?
Well, you've had many people on your podcast interviewed about the growth of EV sales, and I think we see tremendous growth in EV sales as well. And so I think you do see an erosion of long-term oil demand as a result from that. On the supply side, we also see, the growth that we've seen in Canada will not go on in perpetuity either. We see peak Canadian growth around the mid 2030s. Thereafter, it begins to decline. The story about Canada, though, is the oil sands have very shallow decline, so it allows it to hang in there. But Canada will lose volume over time as well. As North America, moves on energy transition through the IRA and now these new policies, also to domestic policy in Canada and Europe, we would expect the refined product demand to be impacted. But North America's waning demand could free up volumes for export to an increasing degree as well. And that means that the Canadian barrels could move offshore and take market share, as could the U.S. barrels. And you could see that across the system in terms of the export potential for North America could increase as demand within the continent falls as well to markets like as Asia, and what happens in Africa matters as well. So all things, certainly you're talking about the implications of EV on gasoline demand, and then potentially, more efficiencies in the heavy duty fleet. Certainly that'll affect oil demand generically. But supply will also see its own changes in terms of the maturity of the plays and the declines that we expect from those plays. And then you and I have talked about this before. When we think about the oil sands, we're not seeing greenfield projects. We're not really seeing even brownfield projects. We're seeing optimizations come in. So they're squeezing the system they have to get as many barrels as they can, because it's very capital efficient for them to do so, but we're not seeing large scale upfront out of pocket investments in new development coming from the oil sands.
Now, the last time you and I talked, which was late last year, Kevin, you were talking about 500,000 additional barrels of oil sands supply between now and 2025, I believe it was 2030 for sure. And now I've just heard you say that you expect the Canadian supply to peak in 2035. Is that, were you talking primarily about the oil sands or just Canadian supply in general? And if you were just talking about it in general, when do you forecast that the oil sands bitumen production will peak?
So oil sands production makes up the bulk of Canadian production. So what happens in the oil sands will influence the overall trajectory of the basin. So we do see oil sands growth continuing into the 2030 mark, but it is around the 2030 mark that we see that inflection point. So with this, so after that, we would expect declines from the Western Canadian Basin. Those declines are going to be different for the different sources of supply. Like I said, the oil sands does have this very shallow decline rate, but in the early 2030s, we do start to meet the natural end of some of the facilities' life. Some of the smaller facilities could run out of production. So you could see that start to take shape. So I'm talking about the Western Canadian Sedimentary Basin as a whole, Markham, and we've seen that around the 2030 mark. And I think you've seen that in the inflection points we posted. We post a public oil sands outlook every year. We'll be doing that again this year. And I think you've seen that inflection point. Just as we move through time, it becomes more apparent because we provide a 10-year production outlook to the public. And every year you see another year out, so to speak, in terms of that production outlook. But the story, you and I have talked about this many times, the story of Western Canada is changing. It is much like the U.S. basin. The idea of fiscal discipline has, dominates the interests of the companies and returning shareholder capital, and that's how they're competing now. But also the importance of decarbonization has become part of the narrative as well, as companies prepare to position themselves, frankly, to compete on carbon. So, the market is looking for a differentiated product from hydrocarbons that include carbon intensity as part of that balance in the valuation.
I wrote a book in 2019 that basically argued that the oil sands got decarbonization as a marketing tool because eventually this scenario would arrive, and here it is 4 years later. But explain what it means in practical terms to differentiate yourself or compete on carbon for the oil sands producers.
Well, I would talk about it more generically because I don't think it's something isolated to the oil sands. We are seeing interest, and we've seen evidence in the market of trades being formed up around the relative carbon intensity of cargoes. And a lot of it's been, I'd say, testing the water, so to speak, but it does indicate there's interest in trying to differentiate not only the quality of a product in terms of the properties of it, but also the carbon intensity, so the environmental impact from it. We think the market has struggled to fully incorporate that because of lack of consistency in the availability of the information in terms of the carbon intensity of those cargoes, but also the confidence in the carbon intensity assessments themselves in terms of the level of quality that goes into those assessments. And those are the, if you think about market formation, those are the fundamental pieces that a market needs. It needs information to understand what it is. So you need to have parties agree that we agree on that information. And then you need to have confidence in that information as well. And so both those pieces, we see the market, testing the waters. We see some trades coming in and out. We've seen, net zero cargoes and different types of net zero cargoes using different methodologies to them. That indicates the market is interested in it. But we still lack the complete information and the transparency for that occur. And we can talk about the stuff we're doing in that market. We're doing a lot of work in terms of providing carbon intensity assessments to allow the market to understand that better. And that's something we're going to continue to do because we do think this is important. And we do think this is what, frankly, traders and buyers want to have happen.
So the trends that I was writing about in 2019 have now kind of come to fruition. But it's still very nascent, I guess, people are, as you say, testing the waters, trying things out. But if you were looking out 2 years, 5 years, would you expect that emissions intensity will play a much bigger role in purchase decisions by customers?
I don't know if I can put a time frame on it. Certainly these things do take time. And you think about market formation, going back in history, it takes decades. But I think there's a lot of interest and there's a lot of need in the market. And I think everybody recognizes that to get on with it a lot faster. So I do think it is coming. And like I said, we are seeing indicators to it. And I think he will be providing that consistent basis of information that we can have confidence in. So also providing information around quality of the information going into the carbon intensity assessments. I do think we'll continue to see people interested in taking those and testing the waters around that. And we do see companies themselves, trying to get a better handle of their emissions, but also the emissions of the products they're consuming. And so there's a lot of interest from everything from the companies that manufacture shoes through to the buyers of LNG and trying to understand what is the relative carbon intensity of a cargo or a delivery of a certain piece of merchandise. And that information and understanding is really essential for the market to form up around that.
Great. Kevin, a pleasure as always. Thank you very much for your insights.
Thanks for having me.